The trade deficit that the United States has with the rest of the world started ballooning in the late 1990s. All presidents before Trump have pussyfooted around this issue, not wanting to upset various trade partners and, more importantly, not wanting to upset corporate America. But the trade deficit just kept ballooning. In 2018, the trade deficit in goods jumped by $84 billion from a year earlier, or by 10%, to $890 billion, the worst ever. So that's in goods. In services, the U.S. has a trade surplus with the rest of the world, and it inched up by $15 billion. So the trade deficit in goods and services combined jumped by 12% in 2018 to $621 billion, the worst since 2008. When it was Trump's turn, he put international trade near the top of the presidential agenda, where it should have been 20 years ago. So that's a good thing. But how have these efforts worked out for the U.S. so far, and where is this headed? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, March 17, 2019. The United States and Canada have a huge bilateral trade. In 2018, about $300 billion worth of goods were exported from the United States to Canada, and about $320 billion were imported from Canada. This is a huge amount of activity, and it generated a goods deficit for the United States of $20 billion. But the United States has a surplus in services with Canada, and so overall this huge bilateral trade relationship is fairly well balanced. It's hard to imagine a more balanced trade relationship. So Canada is not the problem. The problem is China, and to a lesser extent, Germany and Japan. And with China in particular, we need to look at China and Hong Kong combined because of the transshipment through Hong Kong and the invoicing through Hong Kong. So with both combined, the U.S. trade deficit with them soared by $45 billion in 2018 to a phenomenal $390 billion, the largest ever. And that comes after a 7% jump. So this was a 13% jump, and it comes after a 7% jump in 2017. Imports rose by $33 billion, and exports actually dropped by $13 billion in 2018. The issue there is not necessarily China, though there are some problems that need to be addressed, and President Trump has put them on the agenda and is working with China on them. These problems include China's joint venture requirements for U.S. firms. It includes tariffs on U.S. products that are being sold in China. It includes required technology transfers and other issues that are serious issues in China and that do need to be addressed. But when Chinese products fill the shelves at Walmart, it's not China that forces this to happen. When Ford builds a car in the United States with components that are made in China, it's not China's problem. This is not China's fault. When pharmaceutical makers are selling products that are made in China or in other countries such as India, it's not those countries' fault. This is corporate America. Corporate America is doing what the system encourages it to do. There are certain benefits in the U.S. tax code that encourage companies to transfer production overseas. There's the issue of cheap labor that is prevalent in other countries such as India and China and Bangladesh and many others. American companies are encouraged by the system to move the supply chains from the United States out into other parts of the world, and particularly to countries with cheap labor, and the tax benefits too. What the Trump administration hasn't done at all is to separate out the two issues. The one issue is in China, and the Trump administration is addressing that. So the technology transfer requirements, the joint venture requirements, the tariffs on U.S. products, and those kinds of things. And then the other part is corporate America, which has transferred the supply chain overseas. Corporate America just got a huge tax cut, and that tax cut was on net income. This tax cut has not been passed on to consumers. This was a tax cut exclusively for shareholders, for stakeholders in these various companies, including executives, and consumers have not benefited from those with lower prices. And this tax cut on net income should have been packaged together with the tariffs. Tariffs are a tax on profit margins. Opponents to the tariffs instantly claimed that tariffs were a tax on consumers. But that is bogus, that argument, because prices for consumers, prices that consumers are paying, are set by the marketplace. They're set by other companies that are competing with each other. Each company has its own sales objective, and in order to achieve those sales objectives, they have to set a price. And that price may be slightly higher or slightly lower than competition, depending on where it wants sales to go. But if GM wants to overcome a 20% tariff on the Buick Envision, which it imports from China, it would have to raise prices by some amount, and other competitors, so Honda and other companies that it competes with, would also have to raise prices to allow GM to get away with this. But they're not going to. Some of them are assembling their competing vehicles in the United States. Others are being assembled in Mexico and so forth. And prices are set by the market. Corporations are already charging absolutely the highest price they can possibly charge while still achieving the sales objectives. This is always the rule. No corporation will cut prices out of the goodness of its heart. It's always with a sales objective in mind. And so prices can't be raised in a competitive environment unless a company has a monopoly, and then of course it can do whatever it wants to. But in a competitive environment, the marketplace sets prices. So when you charge tariffs on profit margins, that's a tax on profit margins for imported merchandise. These tariffs cannot be passed on to consumers. It's just a tax. Now, a tax is something that a company wants to avoid, and they have elaborate strategies to dodge all kinds of taxes. So when you tax imports, the company will try to figure out whether it is cheaper to produce in the United States or to leave the supply chain outside the United States and just pay the tariff on those goods. And this is how the tariff should have been packaged. They should have been packaged as a tax on profit margins for imported goods. They should have been pitched as a way to change the system where the system no longer systematically encourages companies to offshore the supply chains. But this is where the Trump administration completely bungled the trade issue. It is hounding China, but it is not hounding corporate America. It is not addressing the system that encourages corporate America to move more and more of its supply chain over to other countries. And this system is not that hard to fix. If the Trump administration wanted to, it could have pitched the tariffs as a way to change the system to encourage companies to think twice about where the supply chain ought to be. After the automakers collapsed and the component industry along with them in 2009, much of the supply chain work went over to China. And that includes the formerly captive component makers of GM and Ford. These components are now manufactured in China. They are imported and they show up in vehicles that are assembled in the United States. This was a corporate decision. This was not China's decision. This was a decision made by various component makers that were trying to improve the profit margins, that were trying to improve the profits, and they were trying to take advantage of the different benefits that are in the system for offshoring production. But this is the most pro-corporate America administration in my lifetime. And it is clear that it is a lot easier for them to go after China and hound other countries than it is to take some benefits in the system away from corporate America. The tariffs cannot be properly pitched with this sort of attitude. The tariffs have to be pitched as some tax that will balance out the system and will take away some of the benefits that are in the system for moving supply chains overseas. But of course, this administration cannot do this. The primary cause for the huge and ballooning trade deficits is corporate America. And the primary reason why corporate America is doing what it is doing is because the system encourages it to do that. So unless we change the system in some way and tweak the benefits that are in it for corporate America to move the supply chains overseas, nothing will change. Trump may hound China on a few items and China may concede, but unless corporate America changes the way it looks at its cost structure, the trade deficit will not change. Once we put tariffs on imports for all companies, then this will shrink profit margins unless companies move the supply chains back to the United States. This is a rational corporate decision of the type that corporations make all the time, every day. They look at drawbacks and they look at benefits and they calculate these things out for many years, and then they make changes based on what would maximize their profits. And if it maximizes the profits to move supply chains back to the United States, they will do that. But for the Trump administration, that's a no-go. So we will not see this change. What we will see instead is minor concessions from trade partners and trade deficits that will continue to balloon. And it has simply to do with corporate America and not with China and not with Japan and not with Germany. These are things that we should regulate in-house in the United States and change the benefit structure and the system for corporate America. And we cannot expect other countries to do that for us. So I don't think we will see any improvement in the trade deficits going forward until this issue is properly addressed, or until it gets to the point where the trade deficits no longer work out, where they're no longer sustainable, and we face serious economic consequences because of them. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.